Okay guys, so I've had a few questions asking how to pay yourself if you set up a limited company. So I thought I'd put together this video to talk about the various areas you need to consider, and then at the end I'll show you an example salary that you can pay yourself, in which what I believe is the most tax efficient way to pay yourself as the sole director of a limited company. Now before we get into the video, I just want to say I am not a qualified accountant. Any advice in this video is just my opinion. However, I have been running limited companies for over 10 years, so I'm fairly familiar with this process, so I believe the advice I am giving you is accurate and should stand you in good stead if you do choose to follow this path. So what I'm going to cover corporation tax, income tax, national insurance, dividends, and then finally show you an example of a director salary for 2019-2020. So let's kick things off with corporation tax. Now, corporation tax, hopefully if your business goes well, is what you will be paying on any of the net profits that your business makes. So what I mean by net profits, well, that's the profits that are left after all of the expenses have been paid. So your cost of goods, salaries, stuff like that. Once they've all been paid, then your corporation tax is paid on the residual profits. So that's how corporation tax is calculated. The current rate for this tax year 2019-2020 is currently 19%. And from next year, that will be dropping down to 17%. Now, over the last few years, the government have been dropping this slowly. The reason behind it is they want to encourage inward investment into the UK. So by reducing the corporation tax that companies have to pay, hopefully more businesses will invest in the UK, creating more employment and more growth for the UK. That's the theory, at least anyway, but it's good news for us either way that corporation tax is coming down. So with regards to allowable business expenses that can be offset against your corporation tax, these are some of the common examples. There are many others, and with any expense, always check with your accountant whether it would be allowable before buying it to make sure that you can actually offset it against your corporation tax. So some of the most common ones: your salary. So this is the monthly salary that you'll pay yourself. This is excluding any dividends, which I'm going to cover later on in this video. There's also your home office use, so you can claim £4 per week or £18 per month if you use a home room as an office. HMRC will not quibble this, and you can claim these fixed rates. You don't have to provide any proof. You're allowed to claim this every single tax year, so you can effectively pull this money out of the business tax-free every year. One mobile phone per director. So if you're a sole director, your mobile phone, put it through the business, and HMRC will not question that. Fuel, keep a mileage log of any driving you do. So if you're going to a photo shoot, or if you're going to the bank, or maybe like me, I've got a mailbox, so once a week I go to the mailbox, I keep that all in a mileage log, and then every single mile you do, up to 10,000 miles, you can claim back 45p tax-free, that you don't have to pay corporation tax on. So it's really important to keep a mileage log, because sometimes if you do a lot of mileage, it can add up to quite a bit of money that you can get out of the business. You've then got your associated accountancy fees, any banking fees, any software fees such as Xero if you're using accountancy software, and then other softwares such as Helium 10, Jungle Scout, and all of the other stuff you will use for your Amazon business. Like I said, this is just an example list, and there are many other business expenses that you should be able to put through. For example, buying product samples, stuff like that, you'll be able to put them through as expenses, and then you won't have to pay corporation tax on them. Okay, so the next thing is your income tax. So you'll probably be fairly familiar with income tax. If you've been an employee before, you pay income tax usually on your monthly wage. So this is paid on your income, excluding any dividends. Like I said earlier, I will cover that again later in this video. This is an allowable business expense. As you mentioned on that last slide, your monthly salary is an allowable expense and can be offset against corporation tax. So every pound you pay yourself, you don't have to pay 19% corporation tax on. The personal allowance for 2019-2020, so this is the threshold up to which you can get paid from any business and not have to pay any income tax on. That's not any tax, that's income tax. You've still got national insurance, which I'm going to cover on the next slide. So your personal allowance for 2019-2020 is £12,500. And the additional tax rate once you pass this are as follows. So you've got a basic rate, anything above 12,500 up to 50,000 is at 20%. Then you've got 50,000 to 150,000, which is 40%, and anything over that is 45%. So that's the income tax. And then this is when it gets slightly more complicated, and this is national insurance. So national insurance, you have a personal allowance, and your national insurance personal allowance is 8,632 this year. Now when you compare that to your income tax allowance, you'll notice that it's a lot less. So you've got 8,632 versus 12,500. So anything above that, you're then taxed at 12% up to 50,000, and anything over 50,000, it drops down to 2%. Your national insurance primary threshold, which is effectively this divided by 52, works out around about £166 per week, or £1,719 per month, which is what the recommended salary is for this year. I will cover this later in the video in a bit more detail. So that is at the point at which you would start paying national insurance if you were paying yourself as a salary and not topping up with dividends instead. There's also something called the National Insurance Lower Earnings Limit. Now this is important because you need to pay yourself a salary above this limit, because if you pay above this limit, you get your national insurance contribution token for the year, which goes towards your state benefits such as your pension. So it's very important you pay yourself a salary above this. However, you don't want to pay yourself above this rate, so you want to find somewhere in between. I usually pay just below this, and that way you get your benefits, you get your tokens, but you don't pay any national insurance tax on that. The other reason as well for not going over that threshold is, as you own the business, you are technically an employee and an employer at the same time. And if you pass the national insurance threshold of 8632, the business will also pay the national insurance at 13.8%. So if you're a business and you paid yourself all of your salary and you went past the threshold, you would be paying a combined tax rate of 25.8% national insurance alone. That's on top of any income tax you'd be paying. So that's why once we get to this threshold, we switch to dividends, which are a much more cost-effective way of paying yourself. So dividends, and what are dividends? These are only payable from profits you've made within the business or retained profits from previous years. So if you had a really good year last year and you haven't taken down all of the dividends and you're going through a bit of a slow patch, it's not the end of the world because you've got retained profits that you can then draw down. They're only payable to shareholders, so you have to be a shareholder to be able to pull down a dividend, and if you've got multiple shareholders, the dividends are usually equally split between those shareholders. If you decide to pay yourself this route and then at the end of the year you find your business wasn't actually profitable enough for the dividends you have paid, what usually happens is that dividend, your accountant will class it as a director's loan, and then you can either repay that as a director's loan back to the business, or you'll pay the relevant tax on it as a director's loan instead. The standard dividend allowance is £2,000. That means on top of your income allowance, you can draw down an additional £2,000 of dividends tax-free. So £12,500 income tax allowance plus £2,000 dividend allowance gives you a total of £14,500 tax-free allowance per year, but it's not as clear-cut as that, as I'm going to show you in a minute. Plus the remainder of any unused personal allowance. So for example, your personal allowance is £12,500 as we covered on that first slide. However, if you've only drawn down a salary of around £8,000, which is probably what you'll be doing if you're staying under that national insurance primary threshold, then the remainder of your personal allowance can be drawn down as tax-free dividends. So if you pulled a salary of £8,000 and you had a personal allowance of £12,500, then you can pull down an additional £4,500 of tax-free dividends on top of the £2,000 allowance you already have. The dividend tax rates, they fall into the same brackets as the income tax brackets. However, the percentages are different because you've already paid corporation tax on this money, so they don't tax you as highly as they would on the income tax. So, based on all of that, what do I recommend is the best way to pay yourself in 2019-2020 as a director's salary? So let's do a quick recap. You can earn £14,500 tax-free in this tax year, which means it's £12,500 personal allowance plus £2,000 dividend allowance. However, do not pay yourself £12,500 as your salary due to the double national insurance that I covered on the earlier slide. What you want to do is make sure you stay under that national insurance primary threshold, which for this year, I'm paying myself £719 per month. That's what I'm paying myself per month, and then the rest I'm pulling down as dividends. So an example based on if you're pulling down £40,000 from your business per year, you're the sole director with no other employment. So if you've already got employment elsewhere, this will impact it, and this is why it's important to speak to an accountant. Or if there's multiple directors, again, speak to an accountant, because there are things they can do with national insurance. There's an employee's contribution allowance that can be used. But to keep this video simple, this is focused really on sole director limited companies that have got 100% shareholder stake that have made profit for the year. So if you're pulling down £40,000, this is what I would do. Firstly, take a monthly salary of £719, which adds up to £8,628 per year, which is just under the £8,632 national insurance primary threshold, but above the lower level threshold, which gets you your pension contribution token, which you need for that year. Dividends from the remainder of that 8,628 to the 14,500, so that's the rest of your allowance plus the 2,000 dividend allowance. You can take another 5,872 tax-free at zero, so you can effectively still pull down £14,500 tax-free. You just do it by using dividends instead of taking the full £12,500 as income. And then from the dividends from £14,500 to £40,000, you pay at 7.5% dividend tax, which means in total on those £40,000 earnings, the only dividend tax you would pay is £1,912.50, and you usually pay that at the end of the tax year when you process your self-assessment, you declare your income, you declare your dividends, and at that point you even have you don't do it at the self-assessment. You don't have, I think it's about 9 months after your self-assessment, or from the date of when the self-assessment is requested, you have 9 months to then pay your outstanding balance. So hopefully you found that useful. If you did, please hit the like button. It really helps the channel grow. If you aren't already, please subscribe to the channel, and I'm going to start a thread discussing directors' salaries and incomes from limited companies on FBA Elite forums. So if you're not already a member, head over there, sign up, and I'll see you guys on the forums.